Hello ladies and gentlemen, and welcome back to C.A.R. Entertainment. I'm your host Don Hamilton, and today guys we're going to be talking about company accounts and our continuation of our A21 business studies revision videos. And we haven't got long to go guys, only ratios and investment appraisal after this, so not long to go guys. These company accounts are going to continue out from our account definitions. So company accounts are us just going through the income statement and statement of financial position and how company accounts are useful to a business. So let's get straight into it. So who uses company accounts? Well, a shareholder is going to use it because that gives them their dividend information, their profit, some business strength as well. Governments will use it because they need to know the investment that's been undertaken in the local economy. Banks need it because they need to know that the business is financially stable and they're worthy of credit. The directors know it because they need to know what the wealth of their shareholders are, and also will encourage shareholders to invest. And suppliers need to know because they need to know that they're financially stable as well. So the annual report then, what happens at the end of the year in the annual report? Well, you'll outline your company aims for the upcoming year. You'll have your chairman's report, your director's report, your auditor's report, and then your financial statements, which is what we will talk about today. So cash flow problems are involved in company accounts because cash flow problems will occur whenever a business has too much cash, too much credit, which means they have too many loans and stuff like that. They have too much stock, they're in a weak economy, they're over trading, which does exist, or if they're operating in seasonal trade as well. But this may not be a problem for some companies that actually are based in seasonal trade, such as Christmas trees and stuff like that. So how can you solve cash flow problems? Well, fast turnover, that's why the Christmas tree market is okay, because they have fast turnover at Christmas time. They can have longer repayment periods of their credit. They can remove idle assets. They can go through subcontracting. They can also collect some debt and go through a lease as well. So let's go through our first account, which is the income statement, and this is a historical record of trading of a business over a specific period, and it will show the profit made or lost by the business. And the difference is between the firm's total income and total cost. That's how you get your profit, as we know. So the several important purposes that the income statement provides is that it will allow shareholders to see how a business has performed and whether it has made an acceptable profit. It will help identify whether profit earned by the business is sustainable. It will enable comparison with other similar businesses to see if they're out-competing them or not from a financial perspective. It will allow providers of finance to see whether the business is able to generate sufficient profits to remain viable. It will also allow directors of a company to satisfy their legal requirements to report on the financial record of the business. The statement of financial position, on the other hand, will summarise their assets, liabilities, and the capital that the business has at a particular date. It will list your non-current assets, your current assets, current liabilities, and non-current liabilities. If you don't know what these things are, go watch our account definitions video. They will state these. The advantages and disadvantages of the accounts in general, not just the income statement or a statement of financial position, but both of them. What are the advantages of a business using it? Well, it gives an insight into your finances. It can be used as a tool to judge performance. It's a useful tool in the decision-making process. The limitations, however, is that it's mainly numerical. It doesn't actually give you any qualitative data. They become out of date quickly after about 2 or 3 months after published. They're more or less irrelevant. They're limited for decision making because they're summarized, don't tell the whole story, and window dressing may occur as well, where you make up some of your facts, which is illegal, but it does occur. So thank you for watching this video. I've been Don Hamilton from C.A.R. Entertainment, and I will see you next time.